In this week's update, why this rally should continue, but what could derail it, where the market sentiment has shifted, gold increasingly bullish, and the Bitcoin reality. My name's Garry Davis, and as always, this is general advice only, and please remember to like and subscribe the video. If we go back a few months, into the latter part of 2020, the market was prepared to pay quite high multiples for growth and a great story into the future. And we saw some amazing rises. But that all changed abruptly when the yields on the 10-year US Treasuries went above 1.3, 1.4%. Now, since the disruption that we saw in February and March, it has recovered a bit from heavily oversold, but there's now a question mark about just how early stage growth stocks are going to be treated by the market from here on in. I think there's definitely a shift, and maybe it'll go back to the way it was in 2020, but there's certainly a question mark over it, that's for sure. Large cap tech stocks really do look set to continue their advance, probably with more volatility. But the best looking and smoothest trends are actually in other areas, and that's one of the things that I want to look at in this particular update, because there's definitely a sentiment shift in the market, and it raises the possibility that you may need to consider rebalancing your portfolio to a different mix. So we've got a lot to get through. Let's jump into it. So the reasons why the rally in markets in general should continue are these. There are very powerful economic trends as a backdrop. There's no question about that. Obviously in the States this is very much the case, but with the amount of stimulus going on around the world and the decarbonisation moves around the world, there are very powerful trends, and that's going to continue. In the US, earnings coming through are absolutely smashing estimates, and these aren't. Some people think that some of these big percentage gains are only because of this time last year earnings were so poor, but that's not what I'm referring to. I'm referring to the earnings that are smashing the estimates put out by analysts just in recent days and weeks. And the companies are also providing great forward guidance as well. So earnings season, it's still only relatively early. There's probably only about 100 or so of the S&P 500 stocks have reported. But certainly the earnings results have been extraordinary, to say the least. Now, over the last few months, we've seen a back and forth rotation. We saw value stocks from November start to really pick up. That affected some of the growth stocks, which went into a pretty steep decline. And then we saw a bit of a bounce in mid to late March, and then that disappeared again during April. So we're getting this back and forth rotation. But net, what it's doing, if you actually look at the charts, it's actually broadening the number of sectors and industry groups that are actually advancing. So from my perspective, this back and forth rotation is actually strengthening the market. It's a good thing, not a bad thing, and it'll be good for all parts of the market. Now, it's never a one-way street, so what could derail this rally continuing for the next 6 months, year, 2 years, whatever? Obviously, there is the potential for policy missteps at the government level. We saw Biden through the week float the idea of an increase in capital gains tax. That's not really going to disrupt the market to any extent at all, really. But nevertheless, the algorithms fired off, and we saw a big blip in the markets on Thursday. But that was quickly reversed. But look, never discount the possibility that governments can continue to come out with strange ideas. Of course, the potential for just introducing too much stimulus into the system and distorting things too much can lead to unintended consequences. So definitely the potential for policy missteps could be a risk. The other risk is that we get a return, and I don't put a lot of emphasis on this either, but we get a return to normal economics. In other words, we go back to to sensible levels of debt and what have you. But we might see, it's possible that we could see these really high GDP levels leading to rising yield. Now, I think there's a number of factors that are holding the yields down and holding inflation down. So personally, I don't think it's going to happen, but it's there as a potential risk. Because if it were to happen, if GDP did lead to rising yields and yields in the States got up to 3% or above, then debt service costs would kill them, because their debt to GDP ratio now is somewhere around about 100. So that would make life incredibly difficult in America. So my short-term thoughts on the market are these. April and May, certainly the first part of May, are normally seasonally strong months of the year, and particularly for technology stocks. Now, so far, we've had a pretty volatile period, and it's a bit problematic whether we're going to see the normal seasonal strength in technology stocks that we've seen in the past. But what we are seeing is a wider mix of positive trends, and I'll show you some trends which are, I think, probably not getting a lot of media reporting, but just some amazingly resilient trends. Small cap technology has certainly been the big loser in the last couple of months, from say mid-February through till the end of March. Small cap techs got absolutely murdered, particularly renewable energy stocks, which had probably advanced too far too fast. So that's been the big loser. And the question going forward will be, how's the market going to price these early stage growth stocks, which, their businesses haven't changed. They've still got the enormous growth potential, and many of them will make it, particularly in some of the mega trend areas. But the other question is, well, how will the market price them? The market was pricing them to an extreme in 2020, and at the moment, it's not prepared to do that. So how much will that change is the question, and obviously we don't know the answer to that. But I think it's probably safe to say the large cap tech stocks are set to continue, because they're just going to go along with the economic trends and the high levels of GDP growth. So I think that one is probably looking pretty good. But the best trends right at the moment in the shorter term are in mid caps. They're in the retail sector, and there's just such massive pent-up demand to spend that's no surprise. They're also in small cap dividend payers. Small and mid cap dividend payers are going along quite well, and also obviously in infrastructure, because America and elsewhere around the world, there's just going to be a staggeringly large amount of infrastructure built, and you may have read the term in recent years that America's a first world country economically, but third world in terms of infrastructure. And so there's just a staggering amount of money that has to be spent in America to bring their infrastructure up to scratch. But that's going to happen elsewhere around the world. So there's going to be a lot of beneficiaries of that. So as a consequence of this shift and some of these uncertainties, I think portfolios, and this is what I've been recommending to my members, portfolios should be rebalanced to include a mix, an appropriate mix, and this will be different for different people, so you need to think about your own circumstances. But they should be rebalanced to include a mix of broader things, because it's not just about growth and technology. Certainly that was where you wanted to be in 2020, but now I think a different mix is also appropriate. I think holding less of the story stocks. Now, these story stocks, the ones that have got the enormous market potential to grow into the future, that hasn't changed. So I'm not saying that anything has changed here. It's just the way that the market is currently treating them and may treat them into the future. So a lot of these story stocks that have got enormous potential but they're early stage are not moving at the moment. And they've gone down significantly. So I think you should consider holding less of that sort of stock. Don't get rid of them altogether, but just hold less and do more of what's trending now. So just shift the balance in your portfolio to reflect the current reality of the market. Now, large cap megatrend stocks are still trending quite nicely. There's some ETFs that are trending higher as well for people that don't want to necessarily own a lot of stocks. You can cover a lot of ground with some well-chosen ETFs. Another area is stocks with large potential upside and limited downside. So these are some of the story stocks that have still got that large potential upside, but they've reached a point now, they've been, battered down to a level where really they should have pretty limited downside from now. So I think they're still quite viable. So there's a couple of areas. And then, of course, we've got the third area, which is the early stage stocks that have still got the massive potential, but they're not trending, and the downside from here still could be significant. Now, these are the stocks that just did so well in 2020, and I'm sure that a lot of active traders and investors have got lots of these stocks in their portfolios. And the reality is that, I don't know which direction the prices are going to go in the near to medium term. So it just seems to make sense to me that we hold less of those kind of stocks and we hold more of the ones that are working at the moment. Now, just a point on when, if you start looking at a broader market exposure, and there are a lot of recovery stocks like airlines and travel stocks and the like that are doing quite well, but just be aware that a lot of these recovery stocks are going to be subject to disruption in the future and their businesses are going to struggle. So just because the stock price is going up doesn't mean that it's necessarily indicative that the company is going to do well, the business is going to do well. So you still need to be very, very judicious in your selection of stocks that are going to do well and have tailwinds into the future. All right, so that's the market perspective at the moment. So it's really I'd encourage people to think about the balance in their portfolio and get more of what is working now, what is trending now, and less of what is not, what has perhaps amazing potential for the future, but that could be next year or the year after before the market starts to reward that. So if we turn to the American market, the S&P was down by just 5 points for the week, so hardly moved the dial. The Nasdaq was also down slightly, and the Russell 2000 was probably the relative winner, not by much. The indices in America really didn't move a great deal through the week. So, it was volatile for sure, but net didn't really go anywhere. The US dollar fell further down to 90.86. So what looked like a really promising uptrend in the US dollar now seems to have fallen apart, and we've now got lower lows in the US dollar. The 10-year yield continues to slip down to 1.56, and certainly some of the factors that pushed it up into the 1.7s certainly seem to have been transient, and there's certainly a case to be made for the fact that the Fed changed some of the banking requirements, and that may have had an impact on the bond market, with banks being forced to sell bonds. So, I think we're probably now finding a point of stability, and the market's a lot calmer about that. The VIX lifted slightly. We were down to 16.5, 16.6 last week. It did lift a little bit, and that was largely around the volatility that we saw on Thursday. So let's jump in and take a look at some charts. So this is the S&P, and you can see we're just a whisker, just a couple of points off the all-time closing high. I think we probably even registered a new all-time high at 41.94 on the S&P. So if you look at the trend, the 20-day is actually diverging from the 50-day, which means that the trend is accelerating. The price is comfortably above it. This is a powerful trend. There's just no other way to describe it. If we look at the NASDAQ also managed a minor breakout in the prior week, and largely just sideways to slightly down last week. But if we look at the Russell 2000, you can see it hasn't quite regained the highs that it had before, but certainly has found stability. Now let's look at some of the spreads that I keep a close eye on as indicators of where the market is going. So this is really important. This is consumer discretionary versus consumer staples, and you can see we're back almost to the all-time highs. And there is a very high correlation between the strength of this ratio and the direction of the S&P, and that correlation is continuing to work almost perfectly. So that's a really positive sign. If we look at growth versus value, so we did have a period where value stocks did better, but we've now reached equilibrium again, and both growth and value stocks are advancing, and so we've sort of got a bit of an equal balance there. So that chart is also quite okay. Now, if we look at some of the other trends, so these are ETFs that are trending where it would make sense for them to trend. So obviously retail is doing really well in the States, and it's hard to see that that's going to change anytime soon with the amount of money that Americans have got in their pocket to spend and their propensity to spend. So this is XRT, which is and these aren't recommendations, by the way. These are just observations about really strong uptrends. Some of them very, very smooth, as you'll see. So this is XRT. Just look at the orientation of the three moving averages: the green 20-day, the blue 50-day, and the red 200-day, and the relativity of the price to those three moving averages. And this is a very, very strong trend. If we look at mid caps, so this is MDY. Again, this is a very smooth uptrend. If you're looking at opportune times to get into an ETF like this, then if you buy a dip between the 20 and the 50-day moving average, it proves to be a pretty good entry point. So that's another very good trend. This is the Dow Transportation Index. Has just been going amazingly well, and has sailed through this recent period as strong as any. This is an ETF which is about mid-cap dividend payers. So we saw that mid-cap stocks are doing really well, and mid-cap dividend payers also doing very well. And this is very broad brush exposure, but it's a very, very good trend. This is infrastructure in the States. And just a word for Australian investors, there is actually an ETF with exactly the same code in Australia, but with a very different performance, as we'll see. So this is IFRA in America, listed in America. This is IFRA listed in Australia, so you can see quite different. It's just going along, flatlining it at the moment. So just some alternatives to think about. This is the US dollar. You could see we had higher highs and higher lows. We've now formed a lower low. So that would appear to be perhaps the end of the rally in the US dollar for now anyway. This has come back more than just, if this was going to be a continuation of the uptrend, we really shouldn't have violated these lows here. So it looks like the US dollar may be heading back down to test support again. And that's certainly a positive for commodity prices. The Australian dollar has obviously just the mirror of that, and we closed at just over 77 cents during the week. And now let's take a look at Bitcoin, and something that I did through the week for portfolio analyst members. So this was after Monday and Tuesday trading sessions of Bitcoin. So I just put a Fibonacci scale on Bitcoin, and as anyone who watches this weekend video regularly knows, my contribution on this Bitcoin front is purely technical. It's just purely looking at the chart. I wouldn't classify myself as having any degree of worthwhile knowledge about cryptocurrencies. So this is purely a technical look. So from the peak that we recently saw back to where Bitcoin started its run back in October of 2020 at around $10,000 or $11,000, and put a Fibonacci scale on that, and just looked at, well, prices of nearly everything at some point tend to retrace either 38.2% or 50% or something like that sort of dimension. It happens with everything. So I just postulated, what if Bitcoin retraced to this zone? Because technically that would be quite normal. And so that zone is somewhere between 38,000 and 44,000. And what we saw then, of course, was Wednesday, Thursday, and then Friday, we saw significant pullback in the price of Bitcoin, and we did actually see a break of support. So this low that occurred on the 25th of March got broken. Now, on Friday, we had quite a decent dip, and it got down to a low of 47,500. So, getting close to the top of this range that I'd marked on Wednesday. So I still think it's possible. The fact that we've had a break, now we managed to close back above that support level, but we've had a break, so I wouldn't rule out the possibility that Bitcoins could still yet come back into this range here from a purely technical perspective. It'll be very interesting to see how that unfolds. And really this exercise that I did on Wednesday in Portfolio Analyst was in response to a question about Coinbase, which listed the week before last, and whether Coinbase was a worthwhile investment. And the conclusion that I came to is that there's an incredibly high correlation between the price of or the daily turnover in Coinbase, which, even though it's only just IPO'd, has existed as a business for a decade. So there's a very high correlation between the turnover in Coinbase on a daily basis and the price of Bitcoin. And so therefore, obviously the relationship then is between Bitcoin and Coinbase price as well. So that's the background to why I did this exercise. So there you have it. There's a technical view on Bitcoin. Going to Aussie Stocks now, so 77.16 was where we finished, and our index hardly moved either, down by just 3 points. Now, some of the really explosive uptrends that we saw in 2020 with with stocks like Vulcan Energy, just to put one name out there, which went up 1,000% in a fairly short period of time, and we're now seeing the prices have pulled back from those real extremes, and they're just sort of going sideways in a bit of a band. Some people are getting impatient with that, but that's just normal. It's normal for stocks that have had meteoric rises to spend 6 or even 12 months consolidating. So you just need to accommodate that into your game plan. But there are some gems that haven't really started to run yet, that they're early stage stocks. Yes, they've got enormous potential, but no, they're not expensive. They're hard to find, but there are certainly still some out there that are really still quite cheap. So, still lots of good possibilities in Australia. Turning now to precious metals, gold was flat, didn't move. Beg pardon. at 1777. Silver was up ever so slightly. But if we look at GDX as an indicator of what's going on in the precious metals market, GDX is significantly undervalued relative to GLD, and we'll look at that on the chart, and also relative to its 200-day moving average as well. So the fact that GDX has gone up nearly 20% in the last 7 weeks, this isn't a counter trend rally. So some people are arguing that this is just, gold and GDX is in a downtrend and this is just a bit of a counter trend blip. Well, a 20% gain in 7 weeks is more than a counter trend blip. So I think the odds have certainly improved that we're going to see an up leg in gold stocks sustained. And if that is the case, then the typical average over the last 4 gold up legs is just under 100% gain over a period of 7 months. So we've only been running for 7 weeks. So for a start, it's nowhere near long enough, and it hasn't gone anywhere near high enough. So I still think there is significant potential in the precious metals market yet. But again, just remember balance in your portfolio. Don't go all in on one sector. So if we look at XAU, we'll start with silver first of all. So there's silver, just really going sideways. We had quite a strong run into August of last year, and then silver's just gone sideways since then. If we look at gold on a daily basis, you can see here was the rise in gold into August, but gold is trading lower than where it was in August of last year and is still quite comfortably below the 200-day moving average, which has now started rolling over. If we look at this on a weekly, you can see we managed to find stability right on the 38.2% retracement levels. So from the peak in August of 2020 down to the low point, which was in 2018. Then a 38.2% retracement had us here at around 1688, which is pretty much where the gold price found stability, and we've bounced from here. So if we now go to GDX, you can see we've clearly got higher highs and higher lows, no question about that, but we're still below the 20-day, the 200-day moving average. And if you go back and look at all of the prior, beg your pardon, the prior legs, up legs with gold, with GDX, you can see just how far above the red line that the price gets. This when it really starts to move, it gets way ahead of the 200-day moving average. Same occurred here in August of last year. Look at where we are now. So we've still got the potential for a great deal of upside. And if we look at some of the other ratios, so this is the spread between GDX and GLD, which is the ETF that covers the gold price. Now the long-term average for this is around about 0.45, 0.5, something of that ratio. We're still sitting way down here at 0.2. So at the moment, GDX relative to its long-term average against GLD is still significantly undervalued. Now, that doesn't mean that it has to move up, but it just tells you that we don't have a situation where GDX is all of a sudden overvalued because it's just gone up 20%. And there's a bit of narrative out there along those sort of lines. And if we look at the gold to silver ratio, we're still seeing silver just gradually making some headway against gold, as you would expect that it probably would. All right, turning to other commodities now. Copper was up to 434. Nickel, which had fallen the previous week, managed a small advance to 734. And the outlooks here for these base metals still looks really good. Crude oil came off a bit, which was surprising, given that the US dollar was down. And the sector stocks, so if you look at XLE in America, the index for the energy sector, it's broken down now. So it's broken support. So things not looking healthy in energy at all. There's the spot copper chart. You can see it's just continued to advance very, very strongly as it has since the crash in March of last year. And there's the nickel price really just flatlining it. But the long-term upside for nickel is pretty promising. So wrapping it all up, there's a lot of distracting noise out there in the media, in all sorts of different sources. People agitating for a headline. You've really got to try and ignore the distracting noise because, most of it is coming from uninformed sources, and nobody really knows how this is going to play out. And that's why it's so important to just pay attention to the charts and what they're telling you and balance your portfolio according to what is happening now, not according to what you think or what someone tells you they think is going to happen. Because really, no one knows how this is going to move forward. The fundamentals mean less when there are huge stresses in the system, and the stresses are just getting bigger and bigger. So simply focus on what the chart is doing, and don't worry about the fundamentals to nearly the same extent, because you need to know what the market is thinking now. Expect more volatility. I think going forward we're going to have more volatility than we had in 2020. And that's why I think it's important to have more of the stocks that are trending higher and trending higher with relatively low volatility, which is indicating, good solid underlying support. And just adjust your portfolios to reflect that. So portfolio analysts last week, we really got stuck into this and did a lot of work on this, identifying where the current momentums were, and that's going to continue this week. And certainly very much attuned to this theme of rebalancing portfolios. Now, don't go and throw the baby out with the bathwater because technology is not dead by any stretch. Small cap technology is still going to advance at a tremendous rate. It's just that the market right at the moment is just not quite as prepared to award the same values that it did in 2020. So that's it for this week. There's my contact details and website address for anyone that's interested, and we'll be back with you next Sunday. Cheers.